All right, here we go. We got some audio. I'm just going to quickly go over kind of what happened today, and that's it. All right, let's take a look at these charts. So yesterday we were looking for the bears to get rolled over. If you remember, we were thinking, or I was thinking, we'd see like a gap down, and then the bulls pick that up, and we move. So we didn't get a gap down. We got kind of a gap and go, not like an amazing gap and go, but it opened a little higher and kept going. So what happened here is right off the open, you see decay pushes up, and this is one, again, you got to take with a grain of salt. But decay moved from negative to positive, and there's some trapped orders, which immediately bears screw up. And then it pushes down, and we get a lot of noise here. This is difficult to use, but we went positive and we're essentially went negative, and we get a little noisy and we have some trapped orders here. So this I'm looking at a bullish. This is what I'm looking at as bearish. The bears failed, and we take a look at tension. And you see that the bears actually had a little bit right at the open. They pushed down just a little, but price moved against them. And as soon as the bulls came in, bulls also were able to give just a little bit up and push the market. So then we move forward from there. And when things get a little noisy like this, I stop paying attention to signals here. This is too much. So everything past, the fact that we were up and then went down, I start going, I'm not going to pay attention. The next signal was here where this pushed under, and that lines up here. And here's our volume, and that is positives. That's a bullish sample because we went from positive to negative. And that is, we already had a signal here that worked. The second one comes in, it works even better. You could see the impact out of that right there is this little move down and up. That is the bulls moving. They're moving this up, and it pushes this down, and we get a ways, and it comes back up. And right here, we finish up our volume, and there's our bearish sample again. And you can see the bears did just absolutely nothing here. And their price response was a little move down that folded over immediately. It was done. So they failed. So we see that the bears failed twice. 2 failing bears. 2 times. And 2 times the bulls were able to be successful. This here gives us a pretty clear understanding of who's controlling the market. And the controlling party, they're the ones you want to play ball with. It's just not typically a good idea to play with the team that fails a bunch. So we see that. Now, as we move forward, these guys are sitting here, and we can mark out onto the chart probably where their stops were. These guys would have probably stopped out. Maybe here. I'd say above that. This looks like it got pretty close. You could have looked at, I think probably this pop here is the one that wiped out these guys. If you're selling right here, your stops are probably just sitting, I don't know, somewhere up above price. That's where I would just, maybe a little further because you don't want to be too close. Something like that. A little ways away. They were about that far, about that far again. So we could kind of see the stops for these bears, and these guys got pushed until they got liquidated. And part of the reason that bulls were able to get tension to move up was because they had bears to wipe out. And then again, the bulls were able to get this to push up. And if we watch for acceleration, you see it right here. Do you see that? Right there. That is the second group of bears getting pushed out. And if I put a cursor on there, we could see right here, this move up is the one that did it. It's this one. This is the one that wiped out. So we can scoot that up a little higher just to make it match, because this isn't real time. If this was real time, I would have just eyeballed it and left it and then waited for this acceleration. So that's what happened there. So we can see that this group got wiped out here on that little acceleration pop. And we see this group got wiped out right here. And that was on this little acceleration pop. Those line up nice and easy. You can see the bears got in. You could see the bears got beat up. You could see the bulls did well. The bulls were able to control tension and drive it higher. Then as we move up out of here, we get to that point where that you start getting to the point where you need to ask the question, well, who are the bears going to take out now? And you could see, we were down and down. It came up. Here's a sample. This volume didn't work out for me. This one it's right at the sample. I like to see the sample, crosses over and then there's volume. So if anything, this push up would line up with this volume, but it's a little bit late. This push up could line up with that volume, but really it got away right here and the volume lined up. This looks like the bearish right there. That's I think the bears, essentially it was all in the same, but right there, that's where the bears are going to be sitting. So we have another group of bears who came in. This is a it's not a double down, it's a triple down. So they went short again. So what we could do is we can mark out that position again. We can mark it out. You can see where it is. I think that, this wasn't quite lining up, and then finally we got to push away, and I think the bears went, okay, here it is. They traded it. There's the volume, and now the market's kind of on the back side of that position. I'll make it solid because it's a position. Make it red. I'll just get rid of the lines. There we go. Right there. Okay. Oh, these lines are actually showing up on the Zoom chart. That's kind of cool. So we can see where they are. Where would they stop out? Well, I think that this move up acceleration probably liquidated that position. So I would like to see another push up. So what I think is going to happen here is we're going to move down and the market's going to take a look at that position again. And it's going to ask the question, hey, is that still there, or did these guys get out too? So we'll get down there, we'll take a look at it. Now, if the market doesn't really go down and starts to move back out of it, like this, what that's going to tell me is that the market's going to say, if it moves down below that short position, they don't want to pay out. We're liable to pay out to the bears who we don't want to. And then the market will move against it. Why wouldn't you want to pay out to the bears? Well, they're the losing party. It usually means they're the majority. And so you'd rather move favorable for the minority because it's cheap. It's cheap to pay 1% of your population all of their dreams come true than it is to pay 99% of your populations all of their dreams. It's very expensive to pay out to meet the demands or the wishes of the majority. You want to give the wishes of the minority. It's cheaper. So you don't want to move past the sellers. The sellers are the majority here. In other words, the bulls are in control of the market. So that's where what I'm looking at is going on right now, where the market's sort of like, hey, did you guys dump or what? So this is going to come down and taking a look there. And you see tension kind of gave us a little bit of a slowdown right up here. Another tool that I've been looking at, and I'll show you it real quick. It's not going to really change this analysis a whole lot, but it's something that I think is interesting. This position here is what I would call the root or the origin. The root is an intraday thing. Origin will be like a trade, like a trend thing. And since I think the bulls this is not the beginning of the bullish position, I think this is a root because it's intraday. I'd say it's the root position on the day. It's the lowest first position where they were able to build in. I think the root position wants to get into a positive spread. A positive spread is where you have, a long position and you own a put. You are long a put, and the premium, so it's the strike minus the premium. That's this value. I call it the break even. That's above your long. So this is captured. It's captured profits right here, right? So what I want to look for is if this moves up, I want to see where options, somebody filled a position that potentially could hedge against that. And, I can't drop here, but you could see that our origin position is like down here. This one here could hedge in a way that captures gains from a position earlier in the day. This would work. This one maybe, there's not a ton on it. This is not a lot of volume, 500, I think like 1,000 or something, but nonetheless, this is a pretty decent chunk of volume that showed up. And I think right about here, a lot of people took a positive spread. They were able to make enough profits on their outrights to get into an option positive spread with zero risk. There's none. They are free to go to bed, go to Hawaii, and that position cannot lose money. It can only make money. And the reason that you do that is you're betting on markets becoming volatile or moving directionally. So shoot straight up, shoot straight down, because the only, if you have an option here, it's a pretty decent chunk of money that you have to put on the table to get an option. You're going to give up a bunch of your returns for future returns. And that's okay if the market's going to go somewhere. But if the market's just going to sit sideways or not really move a whole lot, it's just going to eat up your premium and you basically just paid for insurance you didn't use. If the market tanks, well, you get to keep the money you kept, that you captured, that difference between the break even and your contract. If it shoots through the roof, then you get to just make unlimited amounts of money and you never really risked anything. So that's where the market's at. And I think we had a little bit, this position is probably, I don't know, 40% hedged or something like that. So it's not carrying a bunch of risk. So if the market decided, let's just say, to crash, these people won't be paying out. No, that's gone. They're not on the table anymore. If you shove down, Mr. Market's the one who has to pay all those sellers, these guys. So it's not that moving down here transfers funds from them to them. That's no longer the case. It transfers money from the market to them, which means who the crap is the market going to find to perform this transfer? You can't do it with them anymore. We saw that they picked up a couple of options to hedge. We could just see that. It was done. It's going to be difficult to move down because you need a buyer to get trapped in who's exposed without any insurance on your position. That's sort of the situation I see going on here. And that's why I think the market's just coming down to test. Hey, are you guys still here? And remember, these guys aren't making any money until they get through this level. They're just upside down and awful. So this is coming around and doing something I like to call playing in your stop. I've just always said that. I don't know. It doesn't make any sense, but that's how it feels. If you get into that position, it sure feels like they're screwing around. It's like they're taking all your money and they're just playing around. They're just having a good time. They're doing whatever they want with it. And the dangerous thing about having the playing in your stop situation, which is defined like this: you get into a position, moves up, comes back right to where that you make about $0, knowing you won't close because you're dumb. That's what dumb people do when you're in a losing position and you want to hold. They get right to that 0 and then they make their way up and boop. This is how playing in your stop works out. So you need to know where the position is. And we've all been in this type of trade. You get into it, they move it, it comes right back. It's almost like they knew where I was, and it's because they knew where you were. It's because they did. So that's what I see this as, playing in your stop. So our expectation is not this. That's crazy. Like, these guys are all hedged out. They're no longer on the table. And probably most of this was all, buyer. This is all just a cash average anyway. So what, like here? And it's hedged. They're not going to pay. So we would need to find a new buyer to pay out in order to move down at this point. So making your way up, yeah, that's a sensible thing to do. And now that we saw that, you see it came down, check the position. Hey, you guys are still here. That is so great. Thank you for holding the bag. I appreciate it. Cool. Let's go. So now we can see, and remember, to pump tension, to pump T, you got to liquidate the counterparty. That's how you do it. When you liquidate the counterparty, remember, this counterparty isn't just somebody with their stops on the chart. No, it's a market wide. This is a New York Stock Exchange. This is 3,060 stocks or so. And this is the possibility space. Tension models that. We're shifting the possibility space of thousands of stocks. This is a huge person. It's not a little somebody. Like the 500 contracts that we saw hedging with the SPX, the only reason I look at that is because it's a model. It was kind of a bigger chunk of volume, and it sort of models what I think's likely going on here. With ES options, SPY, whatever, it doesn't really matter which security you use. So we could see that there was some higher volume there with the puts, which I think really lends itself to say, buyers got partially hedged. If it was like 2,000 or 3,000 contracts, I would say, okay, they're probably mostly hedged. And that's what happened yesterday. So today that's what we're seeing. So I think the market needs to know they're here because these guys it's a directional transfer. These guys can pay these guys, but these guys cannot pay these guys. So the money can only flow one way because they hedged with options. It's a directional transfer. So the market needs to know they're there because the market can't be paying for these things. So, are you guys going to pay? Yeah, we're going to pay. Okay, cool. And then we could start making our way up to find their stops. And that, again, will look like an acceleration. So I think what happened was this acceleration that we looked at modeled out these guys getting stopped. So they stopped here. They stopped right about here. And these guys are probably still holding. So now look, so you see what's happening here. We're getting decay just pushed through zero. We're getting our trapped orders. So sell orders. This is a bullish sample. You buy against sell orders. You don't sell with sell orders. It's insane. You need liquidity. Liquidity is people who are wrong. Doesn't matter why they're wrong. So you want to buy against sellers. So there's our signal. These are the people who say, oh my gosh, the internal energy is going negative. I'm going to go with the obvious thing. That they're filling their orders. And now the market says, oh, I'm so glad that you guys saw that because we needed a bunch of people to sell so that we could bundle that up and hand it over to our clients, which would like to buy. Maybe. Well, the buyers don't have to consume the liquidity. The point is it's on the table. Go ahead. If you want it, you can have it. Once this, so we're at 55, so once that cools down, we're going to have ourselves a bullish sample. And the question that you need to be asking here is, will the bulls hit or won't they? And I think we have a bag holder. One of the maybe a potential issue is that these guys, they're paying out them, but that's, oh well, it's the majority who are selling, not the minority. So they could probably pay out maybe in two directions. The point is that there is a loser. So we have a loser who's probably sitting on a position. We have precedents. The bulls have been successful today. We were able to find out these guys are there. So it's sort of a verified, like a blue check mark on Twitter. It's a verified idiot. So once this finishes up, I think the bulls have everything they need to say, yeah, sure, we'll pick up something here. We could move this higher. The thing that makes me think maybe that there'd be a little bit of trouble here with this bullish position is that if you're the majority, you're here and you're hedged and you have no risk, why would you buy again? I mean, right now you can go home and come back tomorrow. No problem. No problem. I mean, you're all set. You're good to go. You got the thing you were after. You picked up your position for the day. You can sit on it. And tomorrow, come what may. So we could see some trouble here as the bulls already have a position at their root. I don't think that the bulls should miss this hit because they have the precedence. They have somebody trapped. Like, why would you miss? So my expectation is we wait till this gets down to zero. Don't try and front run because while the orders are finishing, you have to remember that is demand. And this is the word that all human beings in trading think is the god of everything. And demand is not the thing that drives the market. The thing that drives the market is something called margin. Margin is the god of all price directionality. It is margin that rules the world. It is the power of the wealthy. It's margin. Debt. Debt is the magic. So demand is what's, demand is the herd lurching forward and getting groupthink going, a bunch of people. So that's what we're seeing here. And that can push price directionally a little bit. The thing is you don't know how many people are going to get, sell orders could started to fill and it could have gone straight to zero. It can go up to 100% and say, we don't know how. 100% basically means, I don't know how long this is going to continue, but it's not showing any signs of stopping. It gets down to 50%, it's halfway to stopping. And we get all the way down to zero, and then the sell orders are basically done. So this demand thing is a way to get the herd in, the groupthink going. And that groupthink helps the liquidity package be more. We can offer more to our clients. Let's let that demand on through. So that's what we're looking at here, a bullish sample to see if we can get that finished up. Outside of that, so while this finishes, I'll keep an eye on that. We can take a look at this indicator, which I think this is interesting. We have currently we have an expansion. Now this is where it started. So there is an expansion target down here. What's important about expansions is that they don't tell you time. It doesn't mean this. So what it means is this. You know that this is a target, but we don't know this section. We don't know how you get to that target. We could see this move. What we do know is the market does want to get to that target. There's a good reason for the market to come back to the expansion target. It's motivated to do that. But that motivation doesn't mean now. We could put that on the back burner. Once we have a situation where the bears have motivation to take control of the market, that expansion target all of a sudden comes into play. You say, well, I know the market wants to use that. So something you mark out and you remember for later. It's not something you start shorting into like, oh, because there's a target, there's an entry. No, I get targets before entries all the time. The target is not related to the entry a lot of the time. Okay, so we do have right here. And you can see we picked up some volume to move up the point of control, move the point of control. This is just upwards behavior. That's what it looks like. When markets get bullish, you constantly are breaking out of the top of the value area. You're constantly pulling the point of control up. Probably volume profile, people would say, but when you break under the point of control, right? And it's like, well, I don't know if that makes any sense. You can see that gold has started to make its way down. That's trying to take out the people who, there they are, these guys, the people who thought that the pandemic was going to end our economy. So I think that this is a dive into bigger swing traders who were just didn't understand how our economy worked. They thought we were still like a gold-backed economy or something. I think a lot of people get that wrong. It's just like, we don't have a gold-backed currency, so what are you doing? Like, more debt's great for us. So we see the volatilities come down. That's, we're just at normal volatility, so we can start to see things like grinding instead of the market just grind up a little bit, squeezes, no problem. So everything looks good to me. I think the most interesting thing still is oil. Gold looks like is trying to get interesting, still in the sort of the mid-range. We get that down here, we're going to say, oh, that's really interesting. I mean, look at the ES. According to the pattern fit average, it's boring. Like, this is just status quo, normal stuff, nothing to see here. The dollar is getting a little more interesting. It's moving up. So oil still seems to be a big driver of attention. Gold starting to look a little bit that way. When you move out of gold, you create supply. It's like, well, if you're moving out of gold, where are you going? A lot of times you're going probably into equities. So that's where we're at with these. Oh, look at that. Okay, so we're about done with those sell orders. A difficult position to pop into here since it moved up, but You know, it came back, it verified this was here. We talked about the setup, reasonable thing for the bulls to do. It looks like they're more interested in filling a little bit more. So we're going to keep our eye here for some acceleration. We want a little pop up. I'd love to see this just go whoop, find their stops wherever that they are, probably sitting up here, find their stops in the close. That'd be great. That'd be great. That's going to get us to where we want to go. And you could see, interesting, we didn't quite get here. So, you know, the market didn't quite get there. And you know what? This didn't actually get there. I was looking at the wrong line. That is my mistake. My bad. It was still just testing the backside of this. My brains. Let's change that a little bit. Okay, so we did not get down. So we still need to do that. I messed up. I was looking at the wrong line. Still same analysis. We come down and get a sample. I thought we'd get a velocity sample, but you know, either one. We don't actually need a sample. I think that what's the most reasonable thing is just to stay on the backside of this. Like you don't want the market moving down through there because that's paying out to these guys. I don't think the market should be doing that. So what I mean by that is if the market does it, we're starting to see a change in character. Why are you paying the bears? Where did you find the money to pay bears? Like, who's funding this? It's not the bulls because they're hedged. So there's a 0% probability that the bulls take a loss on this position. Let me just write that again. 0% probability of loss. So you can't transfer money out of 0% probability of that money getting transferred. So who's paying for this? Change in character. Yeah, so that's where we are into the close. I think that we have gotten tension, you know, up to 38%. Is that high? It's going to start to get, you know, if tomorrow we open up a little bit, we're going to get to 60% again quickly. So, I mean, if we just thought, hey, it's going to keep going tomorrow, okay, that's fine. It's just we're going to need more reason. When you get up to the 60s, really like the high 50s, so, you know, 60%, negative 60% downside pressure. When you're feeling that kind of pressure, you can't just go. You start to need reasons. You start to go, you know, what politicians can we call to cause this, or what news event, or what thing can we do, or can we capitulate something? What can we do? We need a bank or something. You need a reason to get there because you start to need, you know, crazy. You need a little bit of crazy to keep yourself going. Otherwise, you know, the market wants to cool off that tension, and then we work through that analysis. But right now, tomorrow, if we just shot up and kept going, we instantly are going to run into the like, well, you need a reason problem. Otherwise, if just opening flat and continuing like even something like this, totally fine. We could do that. We could see prices do something like this, no problem. That's a kind of the thing I sort of anticipate at this point going into the close right now. We have bears trapped in. We wiped them out twice already. So there are some bears, and those bears will pay. You don't get to make stupid choices and win. You get to pay to be stupid because it feels good when you're, you know, it's fun to be stupid. Here, that's the fun part. When you execute and you're so smart, you shouldn't feel smart until after you're profitable. You should never feel smart when you execute a trade. You should feel stupid and dumb and vulnerable, and it's difficult. They get to feel good here, they get to suffer here, and they get to pay for that wonderful experience here. That's just how it's going to work. You get to pay for it. So this ES at least will move up overnight. So I would not be surprised to see tension open flat because we have bears trapped. I think that would be a reasonable thing to see it flat. I wouldn't be surprised to see it up. I would be, however, a little surprised. This is what would shock me, is if the ES overnight didn't move up and then gap down. This would shock, because that means that overnight we didn't margin call all those people, or at least stop them out, liquidate them. and then we gap down and let them take profits, I'd be like, freaking heck is wrong with you? That would surprise me a lot. It would also get me to say, okay, we're going to reset. We're probably going to do something different from here forward. So I don't anticipate that. So it would shock me. I think that we'll probably stay above this level here. What is it? So around like 38.53 or so. Probably stay above that all night. We'll probably push new highs overnight. And we'll probably open a little higher, about the same price tomorrow. And tension then can accelerate up, show that they got blown out, and then we can do something else. I'm not sure. Because we'll continually need to trap people in. You can't just move markets. You got to find somebody to hold the bag for you. And it's constantly 2-3 times a day. So, 3 is a lot. Twice is pretty typical, at least. 3 times seems like it's like, wow, you guys just kept on chewing them up. At some point, the market will want to trap major bears, which is where that you get the possibility space going like this. And right in here, you get excellent signals for bears. And it's always right at the low of a nice spike down. That's very exciting. And then we can run for, like 2 or 3 days. Like it's like you could get your battery charged for 2 or 3 days. At some point, the market's going to want to do that. So you need to be aware of that. That will be the downside risk. Is so the market's going to say, hey, can we just run down and hurry up, trap some bears so that we can do another 2 or 3 days higher in terms of like a swing trade? That's the mentality. Right now, we just have, these guys are really the ones that are holding on to this and keeping this thing from coming down. If these guys cover, remember, these guys have 0 risk. So you don't want to be thinking, oh, if they get out, it's going to go negative on these guys. Well, no, it won't, because this moved profitable enough that they could get into an insured position. It's not going to do that. It will probably come down to pressure them for sure. But then the most likely thing is for the market to do nothing, because if you move up, you've got to pay them. You move down, there's no one to pay. There's nothing down there. So there's not a good motivated reason to tank. There's just, so I would think, if you're going to do this, that's because you're trying to trap in some bears. That you're not stopping this guy out. He's good. So that's my thoughts for overnight with this. I think we should be pushing a new high, which is pretty close, and it should have a nice spike on it. I wouldn't anticipate a whole lot more than that until tomorrow. Tomorrow we get some trapped people in, and then we can turn them upside down and do exactly what we did today over again. That's the plan, unless something changes. I don't expect this to gap down. If it does, that's a change in character, and it'll kind of shift gears a little bit from what we've done the last couple days. The last like 2 or 3 days have been this exact same story. Trap the bears, stop them out. Trap the bears, stop them out. Over and over and over and over. Bulls have great positions. Bulls are smart. Liquidate the bears. It's the same thing. We've been seeing this for the last couple days, almost like 4 or 5 days. Same thing over and over. So what you have to be good at is being able to mark out where the players are at. You need to know where they are. You need to know where they got in, where they got knocked out. Are they still in? And once you can just mark that out pretty good, then you'll be able to create the narrative around it, say, okay, where are they, and piece together everyone's positioning, and then you can start to deduce, well, this makes sense. It makes way more sense to continue up than it does to gap down. That makes more sense. Perfect. That deduction is the profitability. Profits are always some deduction in the future. Once the future is here, there's no profits in it. You can't have profits in the present. It's not reasonable to think there's profits here. No, there's not. There's a deduction about something reasonable in the future that can capture profits. And that's where you want to make your bets, is about the future. So there it is. If you guys have questions or anything, you could shoot me messages on Twitter. That's probably the best place to get a hold of me. Tell me your thoughts, what you guys saw. There's a fuzzy thing floating. In the charts, did you see this? Were you able to model this out in real time? What do you see? Maybe you see something different that I missed. Let me know. All right, see you later, guys.